Narendra, we live.
Sure. Thank you. Good afternoon, everyone. A warm welcome to all of you in this webinar that we are having today on the GST changes, which have been announced recently in the council meeting, which happened. And today we are going to discuss the impact primarily on the insurance sector as such. I have my co-panelists who will obviously cover the details as such. I have with me Biren Vyas, who's a partner with Grant Thornton, looks at tax planning and optimization. I have my
I think there seems to be some issue. Probably Narendra is not audible. Anyway, I will take this forward from my end. No problem. First of all, welcome all of you. Thanks a lot for joining. I'm Biren Vyas, partner in direct taxes from Grant Thornton Bharat. I have my colleague who is co-panelist Karan Kakkar, again partner in direct taxes, and we both of us will share some insight, and probably then Sanchita Memani, who is heading tax function, particularly in ICICI Lombard. Sanchita, welcome to Grant Thornton Bharat organized webinar. Your input from your end will be very relevant for all of us because those will be with the practical aspects, and business approach will be certainly that everyone would like to know and understand. Welcome to you, Sanchita. Overall, once we look at it, probably what we have in kitty,
You.
basis that probably we'll go ahead with the discussion. Just to highlight and take it forward from where Narendra has left. Overall GST announcements are there, and there are various various articles, news, and news that we are reading, which largely talks about various type of insurance as well, and it was already in discussion since quite some time. In fact, the GST Council agenda was missing for some of the meetings, and people were looking at it, at what will be the announcement and how the benefits will be passed on, or how it will be benefited to the end user. And precisely keeping that in mind, but now that it has been covered, the 0% rate, currently, instead of 5%, 5 slabs, the GST has been reduced to 3 slabs now. People say that it dual, but I said no, it's a 3 slab, 0%, which is the most important for all of us, and then 5, and then 18. Now, what is covered in 0% is, inclusive of few services and few goods. But the key point is the economic consumption of the coverage of 0% is the largest in India, particularly. Please, and precisely it bounces off the challenge to the government, particularly with regard to how to generate, how to get the taxes from the best balance items, and precisely keeping that in mind, the changes are ahead, but still uh, announcements are certainly welcome. If we look at it, overall, the announcements leads us, or probably help us to move towards particular three things, which ideally, in my view, I was in industry earlier for around 14 years and then moved to consulting. Ideally, all the entities should be focusing three core points, which I strongly believe basis this announcement. You can put anyone first one. Number one is the 0% compliance default. We should look at it, probably how though the announcements are from or in between the month, probably uh, how we implement, probably there should be 0% compliance default, not only for the month, but subsequent months as well. Second, importantly, the model should be basis this announcement. We structure out a position adopted, and the structure which is implemented by the entities should be tax efficient, not too conservative, and not aggressive, which is my view, of course, not too aggressive, which leads to the litigation. And largely, the entire country, including the government, is moving towards, including GST function, is moving towards the digitization. The way returns, it's expected that the returns will be generated, or probably refund will be automated very soon, and probably it will be credited within very short period. The way country is moving towards the digitization, we should also focus on more digitization and automation in such a way so that there is minimal intervention, manual intervention at later stage, and no surprise uh, at a later stage. And precisely with this goal, with this, keeping this in mind, the entity should move ahead and implement the announcements accordingly. Uh, for more insight, for more discussion, I will involve both panelists Karan Kakkar, Sanchita, both. I'll request Karan first to align all of us with key announcements, and probably what you as a tax professional look at these announcements. Please, if you can share with us, all of us, so that all of us will be aligned, and probably thereafter we can move to the any questions that we have in mind, or any points that we would like to discuss, interact. Narendra, welcome back. Sorry, in your absence, I have taken it, but
No problem. Thank you for
perfect.
filling in for me. Thank you so much.
Sure.
Connective issue. Mine.
Karan, over to you. I'll just upload the
Sure,
presentation. Yeah.
sure. Thank you, Brain Bhai, and thank you, fellow panelists, you know, to giving me this opportunity to talk in front of you and bring out the GST Council extremely important changes. And as everybody has seen it, it's been second week now from the announcements. They are definitely sweeping reforms, and we call it a reform because a four-tier structure has got down to a two-tier structure. So 28% and 12% goes down, and everything, most of it culminates into 5% or 12%. And there are very few products and services, which get into a luxury or sin kind of a scenario, which goes to 40%. And like Viren Bhai mentioned, the most critical rate bucket is also exempted rate bucket. So I will want to call it a nil rate, uh, and not to confuse with zero rate. A zero rate would have been very ideal for this industry, rather than giving a complete exemption, because that was what was the ask and the representations by the industry, to keep it at 5% or a zero rate, and not to make it exempt due to the free flow of credits blockage which happens due to the exemptions. Nevertheless, these are the broad themes what we are going to cover. Any questions, just to set the house rules, any questions, please post it on the chat. We'll try to address it. And if something gets missed out, we'll open the lines, or we'll just cover those questions in our conversation later after this conversations. We finish with our conversations. Next slide, please. So I'll directly come into what were the recommendations by GST councils. So currently, the tax regime is very clear. Everything was 18%. For both individual insurance policies, be it life, be it health, and group insurance policies was also 18%. ITC was fully allowed. It was free flow of credits. That was the premise when the GST had come in. And even for the third party insurance, for goods carriage specifically, it was 12%, on which ITC was allowed. How the proposal looked like, which through a notification will get in this rate change, which is likely to be effective from 22nd of September this month, 10 days from now. They say that individual life policies and health policies are going to get exempted. So this is a massive, massive change. So we are again talking about exemption here. It is not a zero rating. So, that is going to have a consequence that will have impact, as well as I would say a muted impact for few, and positive impact definitely for the consumers. Uh, Group insurance remains same. There is no change. If it is a B2B premiums, the companies are buying group insurances for their employees. It is same. There has not been any change. The biggest change because of that exemption, the consequences, the blockage of ITC, because anything what is exempt, the ITC is not allowed. So going forward, there will not be any ITC which will be eligible on the individual life and health insurance policies to the insurance companies. So that is a very massive change. Even for the third party insurance for goods carriage, the rate has gone down to 5%. So which is again a very welcome change for the consumers. And here, the difference between 5% and exempt is there is no blockage of ITC. So this is clear cut benefit to the consumers of this goods carriage insurance policies who was taking out. What all kind of policies are covered for exemption for individuals are UREPs, endowment policies, family floaters, senior citizen policies. All these are part of the exemption list now. Next slide, Navin bhai. So we have broken it down on the outward side and inward side impact. So on the outward side, if we see what changes, the GST premiums 18% was charged. Now there will be no tax. Outward supply, today it was qualified as a taxable supply. It will be qualifying as an exempt supply. Documentation, we used to issue the tax
Sorry.
invoice, and now it is going to be a bill of supply.
Sorry. Yeah, go ahead, please.
And consequently, in the GST reporting, we will have to treat it to be a exempted supply. And tax liability was payable after ITC. Now there is no tax liability at all. So all these are, if you see, these are documentation changes. These are GST master changes. These are your system changes. These are your policy pricing changes in nutshell. And how do you report the compliances? These are the changes. What will happen after rationalization of these rates with effect from 22nd of September. So which automatically means that if there is an exemption, we will have to see how much is the benefit which can be passed on to the end consumer, whether entire 18% has to be passed on or it has to be partial. All those workings of the base premiums have to be brought in by all the companies. We need to sit on the table and work out, what is the benefit really is going to be passed on to the end consumer due to exemption. It is not going to happen that 18% if has gone down, the cost does not increase. So every individual company will have to do that working and see for themselves what is their current model, how are they structured these individual policies in their whole business modeling, and then come out with the cost increase or decrease accordingly. The benefit, if at all, will be passed on to the end consumers. What the studies and the experts in your industry say uh, is that it is not going to be 100% probably savings. It could be somewhere in the range of 10 to 12% of the savings to the consumers. Obviously, like I said, it is individual company to company. It is not some jacket formula. It is only the studies what we have gathered from the public domain. Next slide, please. Yeah, so this is what I was talking about. So there are three options available clearly. Whether we pass on complete 18%, I've given some examples also. If 20,000 was base premium and 18% was 3,600 of GST, the companies may want to retain the base premium and entire 3,600 is a benefit which can be passed on to the end consumer. Or they can do a partial pass through, which means do that workings, go back on the drawing table, just see how much the cost is increasing, how much the benefit has gone down from 18% of that GST amount. Maybe let's assume that, after the calculations, if the saving is only 8%, increase your base premium by 10%. And, that's about it. Earlier it was 20,000 or it will be base premium will be 21,800. Still, it is a saving to the consumer. So that sort of calculations or partial pass through is also possible after each individual company, looks at their existing model and does this calculation. Or, there could be companies who say that, okay, this entire cost of because of the exemption, the ITC gets blocked and my cost increases. or rather, if not even increases, there is no benefit which I can pass on due to the increased cost, then probably they want to take a call and not pass on anything and keep the entire premium without GST at 23,600 in this example. So these are clearly three options only available, what we can think of, and maybe Sanchita is here; she can throw some light later on if there is any other option what the industry has thought of. We can deliberate on that as well. Next slide. Okay. So this is the most debated and talked question. What and when and how the rate has to be determined for the policies which were issued before 22nd of September and the policies which were issued after 22nd of September. So as per GST law, there is a section 14 which defines whenever there is a change in law. So these rules have to be applied to determine the rate of tax to be applied due to change in law, change in tax rates. So we have given some illustrations. So it is called 2:3 rule. So assuming the policy issue date is when the coverage of that individual starts under that policy, which means supply of service happens. And if the payment and that policy is being issued before 22nd of September, and if the payment is received after 22nd, and even the invoice for that premium is issued after 22nd, then the GST will be exempt even if the policy was before that. And likewise, I've given another example. For example, if the payment in same policy issued before 22nd was after and the invoice for before, then it will be 18% because it will be taken as an invoice date, when the GST rate has to be pegged. So it is very, very critical to follow this rule. And what we understand, the industry is having different interpretations around it. There are various permutation combinations which are coming. What happens to the existing policies? What happens to the renewals? So we have given certain scenarios in the illustration below in this slide, if you see. And that is our interpretation of law, that this is how it should be done. But I'm sure there are much more nuances than it is simply covered in this slide. But in a sense, this is how the law asks all the taxpayers to look at the impact of rate changes and apply the GST rates according to the time of supply, and how the time of supply is determined is as per these rules. Yeah. So this is another very important period. So let's take an example. If the policy was continuing, in the existing date, which is before 22nd of September, and we've got very, very, even in my family, somebody was asking me that, my renewal date is coming to be September 20th. Can I wait for 2 days and pay after 22nd? I will get an exemption. So to look at it again, what we need to see is when is the time of supply happening. So in this case also, if the policy renewal due date is 22nd of September, however, the grace period is only what we understand to make the payment of premium. That grace period is given so that continuity of benefits can happen. The policy does not lapse. It does not mean that grace period will cover that person for that period. For example, if I am due to pay today, but I pay after 22nd, from today to 22nd, I will not be covered for the benefits if something happens to me. This is what we understand. So, which means the interpretation comes now that my services will only start when my payment is made and the policy is issued from that date coverage, while the benefits can continue as per the old policy coverage which I have been paying from so many years. So in that case, how do we decide the premium is? Again, we have to apply that rule when the payment is made, when the invoice is issued, and when the policy is being started, when the renewal coverage period starts. Because just by delaying my payment milestone, we cannot take a stand that I'm eligible for exemption, because only the payment is happening after 22nd of September. So that is not a blanket rule to be applied. So all these areas, have to be taken care of. But there are other scenarios which are practical scenarios. For example, term insurance policies, where irrespective of the change in rate, my GST or my term insurance premium is fixed. I do not have any leeway, or the insurance companies do not have any leeway to change it, unless and until there is a clause to that, to say that if there is any change in GST rates, the premiums can vary. So if there is any, then please, accordingly, the benefit under the renewal of that term insurance also should be passed. If at all it is, getting covered under exempted rate after 22nd of September. If not, either the company absorbs it or does not pass on the benefit. Again, the choices by the insurance company themselves for such kind of scenarios. And like I said, this is only few examples. I'm sure that there will be many more such combinations and permutations in live scenario what you guys will be facing. So we'll be happy to deliberate after we complete this. And Sanchita is with us anyway. She'll be also throwing some light. So that was the story around your output suppliers. Now we get into, what is the impact on the inward suppliers. So till today, all the credit was available to us because we were covered for GST at 18%. The agent commissions, invoices, marketing advertisement services invoices, rental invoices, IT systems, TPAs, professional, everything was available to us. Going forward, any expense or any input services or capital goods credit which has direct nexus to this individual policies which have got exempted will not be allowed as per section 17(2). Because there is a clear exemption, any credit which is, or any expense which is incurred for providing exempted services is not eligible to take. Eligibility itself goes away. What happens to the common credit if we also have taxable supplies? Because it could be group insurance or any other we supplying, or maybe any other support services to the group companies or anybody we are supplying. So common credits again will get into the rule 42, 43 reversals. So there are formulas given to that, what we need to do that. Here the question comes, what happens to the existing credit which is lying in the books of accounts on 21st of September 25. So we're in by next slide. Yeah. So here the government has come out with some it clarified supply is exempt under new rate schedule, but I have ITC of GST paid in my e-credit ledger. Will I need to reverse ITC? The answer is no, if we also have a taxable supply. However, if the rate has changed to exempt after 22nd of September, the ITC needs to be reversed as per the provisions of CGST Act. So these provisions are nothing but section 18(4), which is in middle bucket, which clearly says there is a proviso to this, which says that due to rate change, if any goods or services become exempt, the amount of credit which is lying in the books or e-ledger on account of inputs and capital goods needs to be reversed upfront. And for any remaining credit will get lapsed. So which means input services will be only remaining. Inputs, I'm assuming your industry will not have many. It will be capital goods primarily, or maximum is going to be input services. So even input services, they are asking us to, they're saying it will lapse. So which is a very, very, very massive change. Now the complication starts here. Okay, fine. The law says that I need to reverse. It will lapse. How do I do it? Is there a mechanism? Yes, there is a mechanism which is laid out under Rule 44, which says that how the proportion needs to be calculated. But the further complication lies that for the credit which is lying in the books, how do I ascribe and say that this was only and only towards my life and health insurance policies, which were individual policies? And how long I need to go back in that common pool of credit and say that accumulation is only on account of this? Or can I say that, okay, it was all common credit, then I will only apply rule 42, 43 reversal. So this has not been addressed. This is something right now also should have more clarity. We expect the government to come out with certain clarity that how do we reverse that credit, which is already lying in the books of account, if at all that needs to be. So these are the points what really need to be taken into account. And of course, there are some various calculations which can be done. But again, they will be certain assumption based. Next slide. So we have given some illustration what happens, going forward after 22nd of September. So clearly, any nexus of expenses incurred towards these individual life or health insurance policies is not allowed at all. If there is any common credit, so in this illustration, if you see below, we have taken if there is a common credit of 150 crores and exempted turnover on account of health insurance and life insurance is 80% of that. So the common ITC reversal, what needs to be done is 120 crores. The only eligible credit which can be retained or utilized later on is 30 crores towards the taxable supplies what we make. So this is how it will happen going forward. Yeah. Next. Next slide. Yeah. Yeah. So in nutshell, on the input and output, we have covered what primarily the issues are, how the things are going to change post 22nd of September. So in overall basis, like I mentioned, it's going to be loss of ITC. Yes, there will be loss of ITC because exemption is going to be provided. There could be margin pressures, whether if the companies decide to absorb some cost and pass on complete benefit, the margins will take hit, or maybe the base premiums calculations change, the top line changes. So there could be, these kind of permutation combinations and the, in the numbers we can see in the balance sheets. There needs to be revisit of pricing models. The systems needs to change, the invoices needs to change, the documentation needs to change, the communication to the consumer needs to change. There could be, because if there is a saving to the consumer, they can have more affordability. They can cover with the same amount what they have saved. They can take more. Probably they get a larger coverage. So that also means business and volumes which the government expects, and more people coming into the insurance coverage. They want to opt for insurance because of the saving, because of that. Are probably impacts, for insurance companies and the consumer. So like I mentioned, it's a win-win for consumer for sure, and definitely a balancing act, for the insurance companies, which needs to be factored. So I have finished, here, and I pass it on to Biren Bhai once. Back to you. Thank you.
Thanks a lot. Thanks, Karan. It was insightful, quite insightful, and people have started posting questions, which shows that probably something which probably is certainly there to discuss. We'll come back on the question and answer. Meanwhile, basis all these announcements, while we are hearing two views. On one hand, while as a end recipient, I am very hopeful that your probably benefit will be passed on to me. And again, on another hand, probably there are some other view where they says that the revenue of government probably might go down to some extent, and how it will impact overall economy, and how it will impact overall country, which is again a question, because it's expected that because of overall announcement, probably there could be some positive impact on revenue and all. We we would like to hear in greater details on all this. Probably let me ask this question to business consulting leader Narendra. I would like to ask this question. Probably overall the announcements which Karan has explained. Where do you see in terms of where insurance sector will stand? Probably how it will be impacted, maybe over a period of time, not short term, but maybe over a long run, how it will be impacted. Over to
Yeah.
you.
The later part of the question was actually very important, what you said, and in terms of short term versus over the long term, because oftentimes we gloss over the short term, losing the sight of long term. I'll take even a step back actually to look at it from the perspective of slightly one level above insurance industry itself. What happens when the tax is levied of any kind, right? The automatic impact is that your disposable income goes down, right? And if the burden can't be passed on to the customer, for example, in those cases, then essentially either the wages will need to go down because I can't pass on the customer, so I need to sell it at the same price. So wages need to go down to accommodate the impact, which effectively reduces the disposable income and spending capacity of the wage earners, or shareholder return needs to take the hit, which in turn affects the reinvestment dollar, so to say, right? So ultimately, you can't create money, right? That's the same money which need to. Now just reverse this. When the tax is taken off, right, exactly opposite virtuous cycle is set off, right? Your disposable income goes up, okay, which either you can save and invest, which propels economic growth, or you spend it on consumption assets, which boosts economic activity, which requires businesses to invest in assets, which in turn enhances the insurable assets, right? So this needs to be looked at as a structural reform, which government is recognizes that at the margin, leaving resource allocation to the market delivers more efficiency rather than the central direction.
In long
I think
run.
that's an important point. And this needs to be also looked at from the overarching goal, which government has espoused of insurance for all by 2047. In India, we have what is called as uninsurance and underinsurance. I was reading in a report that I read that I think the protection gap is some 83%, translating to some $16 trillion, 4 times the size of our economy. That's a huge gap which is there. And I think some of these things need to be not looked at as a stimulus, but as a reform, which will deliver the benefit, not in this quarter or year, but it's a structural measure which benefits will unfold gradually over a period of time. That's how one needs to look at it, Viren.
Perfect. And that, yes, but that's one side of it, and probably we should be getting, insight about how business probably is being internally handled and how it will be impacted. Let's hear out from Sanchita. Overall about these announcements, how do you see, because all the sectors that we have been discussing, apart from food, insurance is the second most discussed sector, particularly as far as this GST announcements are concerned. And probably everybody, any individual, were very individually, people were very hopeful about announcements, and exactly the government has tried to match those probably expectation. But as an insider, particularly, how you see overall impact about this insurance sector, particularly related announcements on entities. Over to you, Sanchita, please.
So, first of all, thank you, Birin Bhai, for having me over. It's a pleasure to be here and share my thoughts with all of you today. Moving to your question, impact on insurance sector as an insider. I think this is one of the biggest reforms which the government has made to aid the agenda of the government to make affordable healthcare. Insurance is definitely a necessity, it's not a luxury. So it's a significant win for the consumers and a great step towards ensuring, financial and medical security for individuals. However, today not all stakeholders are rejoicing. For us as insurance companies, particularly as regards our health segment, we have the input costs which still attract 18% GST while the final products are now exempted. So, there are three major expense heads today which we have as far as the health segment is concerned. First is the acquisition cost. Second is reinsurance. We have claims and we have other operating expenses. Out of these, acquisition cost nearly comprises of 30% of my entire expenses, which is continuing to be taxed at 18% and without ITC. What this means for us as insurance companies is obviously loss of ITC on expenses linked to such policies, ITC reversals, which is a straight hit to the P&L. So this inversion definitely could impact premiums and squeeze profitability to some extent. I would say multi-line insurers still have the ability to offset certain costs against other lines of business. However, standalone companies are hit harder. Uh, and I think despite these concerns, I believe the overall sentiment in the insurance space remains bullish. We do foresee a small benefit which could accrue in claims cost, which is basically on account of rate rationalization of medicines and other medical equipments which are used by hospitals. We also expect or look forward to a lot more penetration, increase in volumes, and definitely lowering the cost of entry will improve the sector's customer base. So all in all, I would say definitely a positive change for us.
Perfect. As a end user, even I'll prefer, say, for an example, if I used to spend, say, just an example, 1 lakh rupee for particular coverage. If offer is there and probably there is a discounted offer, I'll still prefer to spend, same amount, and better to, offer a larger coverage, bigger coverage, and probably that will be certainly my preference. Maybe, of course, it's an individual, it's very subjective, but still, basis this overall announcement, do you see any still unclear, while Karan has already clarified area, but still any gray area or clear area or any announcement which is still not clear? Anything from your end?
Yeah. So what happens is health products are basically can be classified into two broad categories. So we have benefit products and we have indemnity products. So indemnity is basically compensating somebody for the loss due to occurrence of an event, and benefit products is basically payment of a fixed sum on occurrence of an event. What the GST Council has as of now given the exemption on is individual health insurance. Now, this term is particularly not defined either under the GST law or by IRDAI. In the absence of any specific definition, while reference can be made to IRDA definition of health insurance business, this definition as of now covers travel and personal accidents, which are basically benefit products. Now, as far as when we look at GST law, travel insurance is covered under a separate GST SEC code, separate classification. So then that leaves us with an ambiguity as to whether travel and PA, which are benefit products and not indemnity products, would be covered under this exemption, or does the exemption only extend to pure indemnity products? This is, I think, one gray area which still exists. Another clarity, which is, I think, also awaited, is on group structures, whether they would be covered under the said exemption. So group structures can be two types. One is basically an employer-employee relationship where the policy is purchased by the employer for its employees. There could be add-on covers which the employee pays directly on his own. There could also be master policy structures where there's a master policy holder for a particular cohort, and they have the same policy structure and coverage, where individuals are issued a certificate of insurance and the payments are done by the individuals. So in cases where the liability to pay is of the individual, it is to be seen if the exemption will be extended to this category. As of now, there is no clarification, or this does not form part of the FAQ which has been released. I think one more small gray area which still exists for us is bundled products. So there are a lot of products which we give along with our health indemnity, which is personal accident, or the travel products could be an add-on to the retail indemnity product. Again, we'll have to see if we can classify these as a composite supply, where health being the principal offering.
Perfect. No, that's
Yeah.
right. Right, you have clarified. While we are hearing out that there will be few more clarifications with regard to accumulated input credit, and all these clarifications are expected. But before we move ahead on this question, anything current basis or overall this announcement, probably while you have already covered. While I know that 5 areas will be impacted, probably, overall, but Karan, anything particularly transition perspective, you see that what needs to be do in terms of preparedness at this point of time, maybe in a short, probably then Sanchita can cover and add on to same.
Sure, sure. I'll just quickly, reiterate a couple of points. One is, of course, from a transactional impact, see what happens to the existing ITC, see what happens to and how the operational cost, etc., will increase because of the blocked ITC going forward. And cross charge is very important to see if there are any cross charges between the branches. Need to restructure those. We can also probably have revised allocation models and documentations around that. Again, see the point of taxation, time of supply, very, very important as a transition, because that will determine the tax rates, what to be applied, what not to be applied. Because any tax rate which is wrongly applied and taxes paid less, there could be consequences of tax plus interest later on. And see the on the pricing strategy again. The insurance company needs to go back to the drawing board and see whether they want to pass on the benefit, and if yes, how much they want to pass on. They want to revise their base premiums. They want to existing policies, how they want to communicate to the consumers. And of course, changes in the systems, documentation, reporting that needs to be done. Tax invoice to bill of supply to GSTR B2C suppliers as exempt suppliers, etc. needs to be done. Internal training and communication and stakeholder training and communication is something which I think is going to be very, very important, for the insurance companies to clear the, I would say, cloud in the mind of the consumers. Because I'll give you a live scenario. If you open any insurance website, very all different websites are saying something and flashing. Take GST benefit today, take it tomorrow, pay it today. We'll not charge you. So all those the industry should be united. I would say they should talk to each other and take a position that is something should not happen. A varied position, at least for the transition. Going forward, it will be united because the position are going to be same. So that is what I see as a transitional immediate impact, which the companies should do.
Seems too short. Probably seems that Sanchita need to cover far. Sanchita has a far longer list. Probably over to you, Sanchita.
No, so I think Karan has covered it well. I mean, these are what we also foresee, updating our billing systems, issuing the relevant documents, communication, like Karan mentioned, communication with our intermediaries and our customers. We are flooded with customer queries right now as to what will happen to my policy. Can I cancel it? What about my renewal is due, etc. All of that. Transitional impact is very huge on us. Ensuring all the existing policies, specifically, we have long-term products, which are transitioning into this new GST regime, I may say. We are appropriately determining the rate is very important. Ensuring we are taking all the credits where, the invoice is already received by us. Updating our systems to ensure reversals are being done, renegotiating contracts with vendors, who's basically specifically vendors where their goods and services are being repriced due to the rate change. Seeing if my contract has any change in law or tax change in law or change in tax rate clause, and review the mechanisms and implementing these adjustments. So yes, largely that.
Correct, correct. While I was thinking on the response that you were giving, probably there's a key there's a key exercise, particularly key steps which needs to be followed by each entity, particularly whoever is impacted. Point number one, while standard accounting, particularly will be certainly in place, that goes without saying. But how to embed the risk and control metrics to ensure that the right rate is already embedded in the, it's already embedded in the entire process. Then, particularly there's accountability, particularly to look at the, right position. Thereafter, the right parameters, the suitable parameters which are identified to reflect accordingly in the masters. Then you define accordingly and implement the same in the system. You take a desired output report and you just see the how the report is, how the output is. This entire all these steps needs to be planned out and implemented well before 21st probably. So system modification perspective is one, but before that also there's an exercise apart from pricing and all those documentation related preparedness that we discussed. But how you see in terms of entire this process set, particularly with the timeline of 22nd September, Sanchita?
So I think definitely the timelines are tight. There is a lot to do for us before, there's a lot of system. I think health is a very complex product, and we have a lot of variants which are available in the market today. So, and we book policies through various modes. We book through online and offline modes both. So we need to make appropriate system changes in all of these modes and ensure that the positions that we are taking are aligned across my offline and online mode. We also need to ensure we apply correct logics for transition cases. identify which are the exempt product categories, and ensure the systems are geared up for calculation of all my ITC reversals. So definitely, given the time frame, I'm pretty confident we'll have it up and running by 22nd. We'll have to, but yes, there's a lot of work to do at the back end.
Internally, while Karan and myself, we both of us were working on, probably how far impact will be, and we were debating. My view was slightly different, and Karan were, and finally we have concluded that probably somewhere around 5 to 10%, around 5 to 10% impact will be certainly there, not 18. But it's again, it depend on the organization, product mix that they have, what kind of revenue and everything. It depend on multiple factors. That's what. But overall, do you see a pricing impact will be the three options which Karan has highlighted? I know the third one, in my view, third one is absolutely no option for any insurance entity, whoever is impacted, maybe full pass on or partial pass on. Uh, how it will impact on pricing? Any broad level view? I'm not asking for any exact, but I know it's too early to ask for it.
I think insurance companies are still in the process of evaluating the impact. I mean, there's a clear loss of ITC to the insurance companies. I know I've also come across reports which estimate there could be a required hike of 3 to 5%, which the insurance companies might need to remain margin neutral. And but as an insurance company, we're also expecting an upscale in the sales, and therefore it may be required to be seen if pricing division is necessitated. Even if there is, I feel this could be a very short-term impact. So that is there. From a tax perspective, I think what is to be noted is, as of now, we know that there is no legal mechanism for ensuring that you basically pass on the benefit of rate reduction to customers. But it's also noteworthy to see how there has been a shift, or there's been an onus which has been placed on the taxpayer to ensure that the benefit are passed on to the end consumers. So I think companies need to proactively conduct a comprehensive impact analysis, and it's very important to maintain robust documentation to justify price increases if we are going for any.
You have highlighted one important, very important point, and wonderful point, to be very frank. And on that, we should be hearing out from Narendra. Probably, Narendra, people talk about whenever, while you did touch upon this at the initial stage, when industry and people talk about, something like this, rate reduction and probably benefits, what do you see impact on overall volume, improvement, probably how, what, or no improvement? Your view as a from business angle.
Yeah, so look, firstly, just to build on what Sanchita and we've been discussing, in some way the demands for one-to-one fall in prices are in some way misguided, right? That doesn't happen that way. One shouldn't be over-obsessed about it as well, right? Because if one thinks about it, it actually will inadvertently create distortions in the market, so to say, right? So that is one part I just wanted to kind of firstly put out, that the pass-through will happen in an imperfect manner. That's how it's the natural course it will take. That's how it happens in any market, in any industry. And we should resist temptation to kind of micromanage in that sense, right? The market will find its own equilibrium per se. And that's how, coming to your question on the volume as well, I give you a bit of a insight on the economics part of it. When I was saying that extra piece of money which is available, people could very well actually use it to increase the cover as well, right? So one is more people buying it, which is probably what you meant by volume, because it's cheaper by X%, Y% now. But you could very well have people saying that, hey, I would actually use this extra money to buy a higher cover. If I was covered for maybe 1 crore, now I'll be wanting to get covered for 1.25 crore because my outgo is the same. In a car insurance kind of a scenario, people may say, hey, I want to kind of increase my IDV, for example, because there is a reduction which has happened. Let me just increase the IDV %. So you will see both potentially a volume increasing, but also some at risk or underlying some insurance potentially also going up over a period of time. I mean, that one should not goes back to again uninsurance, underinsurance part of it that we were speaking about.
Perfect. Even I agree. I did mention earlier as well, and I agree that if today there's an impact on pricing, there'll be certainly, even I will, or as an individual, I prefer that, probably I'll prefer to spend same amount, particularly for the larger coverage, and it will certainly be helpful. because over a period of time, because of inflation, because a number of other factors, probably it will be needed. Sooner the better, probably is the, something which one should keep in mind. But if we look at it, overall, if I look as a indirect tax GST partner, if I look at overall impact, there are few areas where, slightly it will be it will be revised to the downward as well. Just to highlight, say for example, a car, just an example. Now in case of a car, the rate is reduced from 28% plus cess to lesser amount and probably lesser percentage, which over a period of time, or rather effective from 22nd September itself, entities will have to pass on this benefit to the customer. They have started giving ads. We are hearing, we are looking at all the newspaper that they have started, offering those discounts right now. But because of this, overall valuation of particular, unit, car, or wherever, these announcements are impacted, that valuation will go down and will go down. There's a possibility that it might impact on the premium as well, because the valuation is reduced, coverage is reduced. So simultaneously, corresponding premium should also go down. So keeping all this in mind, probably, while I can certainly answer this question, but Karan, do you think that probably entities will have to revisit the valuation, particularly, or probably Sanchita, first over to you. Do you think that probably one would like to look at, Sanchita, revising the, premium, considering this, will there be any impact? Just probably some point from your end.
So, are you referring to revising the premiums, like basically from a consumer
Basis,
perspective?
basis the valuation, basis the valuation.
So, I mean, you mean to say insurance companies revising their
Insurance
premiums?
company, yes, yes.
I think that's something which I mentioned
It's
that
under
they're still
evaluation.
evaluating and in the
Perfect,
process.
perfect,
So let's see
perfect.
how it works out.
Sure, sure, sure.
Yeah.
And current, because of this, there are various rates probably which are already announced. Yeah, now, in some cases it's 18, some cases it's now exempt. Because of all this, the revenue share will be apportioned to both this rate. Because of this, the cross charge, particularly where I'm talking about the GST cross charge. Now, whether it will be impacted, because currently, I know many entities we have suggested, we have only advised that probably you can go for a, safe 18%, which will be the best model for you. But now that it will be a split between 0 and 18, and probably where they have a variety of supplies, how, probably how this cross charge should be handled, or probably any view
Sure.
on that.
Sure. So existing scenario, if you see that, everything was taxable, GST was paid 18% on cross charge, ITC was eligible to the branches if it was passed on by the HO or between the branches. No additional tax burden. Life was very simple and pretty. Now coming exemption, life is still simple and pretty, but what happens is everything gets exempt. The ITC or which was available, that is not there. However, my cross charge mechanism, I used to follow any policy because the ITC was fully available. The provider used to help me. Now I will have to do the valuations on the open market value if wherever there are cross charges between two branches. And especially if the branch which is providing exempt supplies, which are health and life insurances, it's going to be very tough for them because that will additionally increase the cost burden of this cross charge ITC tax which needs to be paid. And so automatically what the companies should do is reevaluate the valuation methodology between the branches. It could be probably activity-based costing or actual usage costing, which can be followed to minimize the cost impact. And accordingly, the valuation can be revisited or reduced so that the impact of GST for this cross charges do not, have a very, very large adverse impact. And the another thing what they need to also do is they need to update the documentation around the cross charges, the logics which are applied, the valuation, how it is adopted, the treatment of GST. If if it is totally exempt, then no GST, of course. If it is not, then 40 to 43 applies. what is the method of application, what is the formula taken. All those clear documentation should be maintained so that it can be demonstrated later before the authorities if needed. And of course, be audit ready, because the GST authorities will audit at some point in time, and especially they will go after these cross charges, and they also very well understand the cross charges may also have a reversal of ITC or no ITC at all. So they will want to challenge the valuations, etc. So this complete ecosystem around cross charges needs again a very, very close look and very minute look by the insurance industry.
Perfect. While we are moving towards, we have very limited time. While five questions are already answered by someone, there is one question which I would like to pick up, and probably if you feel that you want to add, please feel free. How do you foresee the GST exemption from Nikhil? How do you foresee the GST exemption influencing product innovation in health and life insurance, especially for underserved segments? First of all, these are underserved segments. Of course, there will be a growth that goes without saying, maybe in a long term, but we see that probably there will be a decent growth now post this announcement because it will be accepted well. But more than that, as far as innovations are concerned, say it will be completely upon it will completely depend upon the mindset and management approach. And as I strongly believe that the insurance entities will do focus on this line, because number one, it will be more efficient for it will be a more cost efficient for an individual to go ahead and opt for this product. Keeping that in mind, possibility of insurance entity, while they'll be the best players to answer this, but possibility of coming out more products offering this probably underserved segment will be very high if I look at it as an individual. If something which is really cost effective today, I'll prefer to take multiple, and as an individual I look at it from this angle. Anyone on this panelist, feel free to add if you have anything in mind.
I think one thing which could come across is basically giving more coverage for the same amount of premium as far as health business is concerned. Also, if you know maybe some new innovative products around group policies to move it to more individual linked policies, so that the benefit can be moved that side as well. Something which can be looked at.
Perfect.
Innovation in
This
structuring.
probably
Innovation in structuring, not
yes.
the product itself. Yeah.
Yeah.
Interesting.
Yeah.
Very true, very true. Now with this, probably since we have very limited time, probably Narendra, requesting you to, for a closing remark, of course, balance questions, to all the participants, will request, do reach out to us, do write, there's an email, probably do reach out to us. We'll certainly answer, we'll connect with each one of you, whoever asked the question, and probably we'll be very glad to discuss with you. But, overall closing remark, Narendra, from your end, please.
Sure. I'll just probably give a minute to Sanchita, possibly if there was any point that she wanted to make and which we couldn't as a guest. Sanchita, first give the stage to you before.
We've covered everything. We've spoken about all of it. Nothing more to add. Thank you so much.
All right. No worries. Absolutely. No, thank you so much, firstly, for coming over to our panel. Thanks, everyone, to you as well. I think it was an extremely good discussion. My key takeaways are it's good for consumers, no doubt about it at all whatsoever, which is the most important stakeholder. That's the reason why businesses exist. That's why each of us exist. So good for consumers. As far as insurers are concerned, in the short run, there might be a blip in more ways than one. It's possible it can last this quarter, it can last possibly this fiscal, so on and so forth. But obviously, as efficient markets do, they will find a point of equilibrium where it will get adjusted. So impact will get evened out and will actually get into the positive territory through possibly increase in volume, increase in coverage, innovation in products, underserved segment, new structures coming in, 18% going off, etc. So it becoming more affordable. So it can only be positive in the long run for the insurers themselves. And the similar impact will be then passed on to the shareholders as well, that they may see, a little bit of pressure on ROI, ROCE, etc. in the short run. but in the long run, it will be good. And needless to say, it is good for the economy as a whole, right? This is not a stimulus. This is not something which is an injection, which is just to kind of get you up and running. This is something which is a significant shift, material shift. It's a structural reform, which will only augur well for us and the espoused vision of insurance for all by 2047. This is a very, very important element in that particular direction that the government has taken. So with that, I'll draw this to a close. I thank all my co-panelists and everyone who's joined, taken an hour out from your busy schedule. Really appreciate, really grateful to you for this. And I hope you have had some good insights, good takeaways from this particular session. All of us are obviously reachable. You will have our coordinates, for reaching out to us. We'll be more than happy to kind of engage with you on any particular specific topic, specific position, or any other aspect which is very, very unique to you, and to talk to you about these particular things. Thank you so much and for being part of it. Bye-bye, and have a good evening and good weekend ahead. Bye-bye.
Thanks, Saurav.
Thank you.